Good afternoon and welcome to the Perennial Value Smaller Companies live webinar. My name is Caesar Farfan. I'm the head of retail distribution at Perennial. To my right, I have a couple of my colleagues. I have Andrew Smith, who heads up the small and micro cap business, and also my colleague Sam Berridge, who's Perth-based, and he's one of our resource specialists in the business. It's been a very interesting year for smalls. It's strongly outperformed the large cap end of the market. The market's returned a bit over 25% in smalls, outperforming the broader market, the ASX 300 by about 15%, which returned 10%. Our fund has done particularly well, returning a one-year performance figure of a bit over 30. So outperforming the Small Ordinaries Index by a bit over 5%. As you know, the X100 end of the market is not only large, but also very diverse and particularly under-researched. Hence today, as you can probably see on your screen now, inefficiency equals opportunity. With such a strong year, you're probably asking yourself where to from here. So before I pass on to my colleagues, Andrew and Sam, just a bit of housekeeping. So you'll see on your right-hand side, there's a navigational panel. There's a little orange arrow there, which you can open and close. More importantly, though, you are all muted. So we can't hear you, but you can hear us, obviously, or I hope so. But you can ask questions. So there's a part of the panel there. If you sort of scroll down towards sort of halfway down, you'll be able to type in questions. We'll most likely answer those towards the end of the presentation rather than through the presentation. But without a doubt, we will be answering those. So on that note, I'll pass on to my colleague, Andrew Smith.
Well, hello everyone, and thank you for your time today to hear an update from the Perennial Value Small Companies team. As Caesar touched on, after delivering 30% net of fees, it's a pretty obvious question: is there still opportunities out there? Is there still inefficiencies in the market which we can exploit to deliver strong excess returns? And we want to share with you today a trend that is sort of increasing, probably for the first time in my investment career. The number of brokers covering the small cap market is dropping aggressively, and we'll share you with some data on that. And so that's adding to what already was a great picture in small caps, where it's a very inefficient part of the market that's poorly covered. But what we're saying today is that coverage is getting worse, and that creates more mispriced opportunities for fund managers like us who do our own research, do 10 years of modelling, historical, and 3 years forward at the very least. That sort of detailed research works best when markets are poorly covered, and that's a trend that we see increasing. So what we've got on the slide here is the universe of companies we can invest in. 779 companies when we last cut the number, and that's X100 down to a 50 mil market cap. Pleasingly, that universe is growing. There's been a lot of floats recently. Floats are always a mixed bag, but it has been some quality companies come through in recent IPOs, and that creates a bigger investable universe for us. But what you also see there is it's a very poorly covered end of the market. So over 400 of these stocks are covered by brokers, leaving 300 stocks which are not covered by anyone at all. So this is really fertile hunting ground. And when you compare the number of analysts looking at stocks in the top 100, so any top 100 stock would have on average 12 analysts covering them. So you look at BHP, that might have 20 analysts covering them. In Small Ords, the number is 6, so half as many people covering Small Ords stocks. And to give you an example, one of Sam's stocks might have 1 or 2 analysts, or in most cases 0 analysts. So Sam, being a geologist by background, can get a huge edge on the market purely by analysing publicly available information, doing the work, and coming up with our forecasts. So it's a very fertile universe for finding excess returns. Some data we want to share from you, and this is a great report that Goldman Sachs put out in March. It's called the Rising Information Asymmetry in Small Caps. And what this chart is really showing is the quality of broker coverage, as I alluded to earlier, is dropping off, and that's particularly in the number of sell side. So number of brokers covering small caps is dropping off. So if you look at the number of estimates that are in the market, if you see there in January 2013, there was close to 1,400 estimates for small cap stocks. So as I said, about 700 companies in our universe, of which 1,400 estimates in the market. So two estimates per stock. That's fallen 40% in recent times. And there's a couple of drivers of that. I used to be a broker, as did Sam. It's very hard to make a good living being a small cap broker. The stocks just don't trade enough. The corporate bankers aren't as interested. And then there's been a few regulatory changes, particularly out of Europe, which has made some of the bigger brokers, like the Goldman Sachs and the Merrill Lynch's and Morgan Stanley's of the world, really drop their small cap coverage under the new tighter regimes. So, for example, Merrill Lynch has completely exited small cap coverage here in Australia. So we think this is a trend that's going into our favour. The other trend that we've noticed is the quality of estimates is also dropping. So the light grey bar shows the number of estimates before a company reports that has been updated within 100 days. So as we're going into February reporting season, or as we're now looking into August reporting season, what we find is a lot of estimates out in the market have not been updated since the last result. So they're 6 months old, and clearly within 6 months there's a lot of macro data that we can use to sharpen up our forecast and get a better feel for what the companies are going to earn. And that information is not getting reflected in consensus estimates, and therefore not getting into the share prices. So that creates inefficiency. To exploit this inefficiency, you need a really big team and you need to do your own work. It's a very big universe, over 700 companies, and Perennial Value Small Caps has the great advantage of a very large and experienced team. So in addition to myself, it's Julian Guido and Sam Berridge, who you'll hear from in a minute. All three of us are out of the broking industry, so used to covering a lot of stocks and have got lots of relationships through the broking community. Damien Cottier, William Wu, they each bring something individually to the market. We have a dedicated dealer in Stephen Yee. That's very important, because it's one thing to come across an excellent idea in small caps. It's another thing to be able to find the liquidity to execute at the right price and to make those returns real for our investors. And then we've added to our team this year with the addition of Marnie, who's doing a great job supporting our research effort. Importantly, incentives are very important in every company we look at. When you're looking at our smaller companies business, we own 44% of the small companies business. So you're unlikely to see any of us set up shop somewhere else. We're locked into Perennial Value Small Companies. We're focused on delivering to our investors over 5 to 7 years, very strong returns. I've touched on how well resourced we think we are to be able to take this research effort. A real advantage I think we have is Sam Berridge, who you'll hear from in a minute, is based in Perth. Sam was originally with us in the Sydney office, but is from Perth, as is his family, and is a geologist by background. Sam was spending an exorbitant amount of time flying back to Perth for company meetings. It was much better from his family and from a business point of view to relocate in Perth. He's sitting in West Perth, right in amongst all the Perth corporates, picking up a lot of great intel. And he's seen 50% more companies in the year he's been in Perth than he did when he was in Sydney. So it's been very efficient. And you'll see there, we did over 1,000 company visits. This is a key part of our process. We're constantly on the road. To give you a live example, Julian got back from Perth last night, and Sam arrived from Indonesia seeing a potential nickel float just this morning. So everyone's constantly out on the road trying to find the best ideas for our investors. And they can be in really obscure places. There's a photo of me visiting Synlait. Everyone was piling into A2 milk, and we thought there's got to be a better way to make money from this trade. And so we went to see Synlait, who is listed in New Zealand, and they manufacture the infant formula for A2 milk. So we made a lot of money for our investors post that site visit. I'll now hand over to Sam to talk about a classic example of inefficient pricing. In this case, we had to be very patient, but we were rewarded last month with the takeover bid. So I'll hand over to Sam to talk about Sino Gas.
Thanks very much, Andrew. Yeah, I mean, it's this contraction of sell-side research is quite a strong and pervasive theme. And as Andrew just mentioned, I mean, being that the ideas generated by the brokers are diminishing overall, then we have to get out there and look for these ideas ourselves. And that's exactly what you can see in that photo in the bottom right there. I was up in China, I think this was in 2015, having a look at Sino Gas. We got onto this story quite early. The move of the Chinese government towards a focus on a clean air policy and cleaner energy was a massive tailwind for gas demand. In that regard, Sino was brilliantly placed with a very large gas asset within the auto space and in China, and you can just see how material that gas asset is in that table, or the chart in the top right-hand corner of the screen. I mean, the total gas in place there of circa 5 TCF compares, quite comfortably with some of these very large tier 1 LNG style assets that are held by the majors. You can see on that chart. So this was a tier 1 asset held within what was at the time a very sort of modestly priced company. I suppose the key issue here, along with getting comfortable with the quality of the asset, that the gas was going to produce at the required rate, it was also getting comfortable with the sovereign risk of operating within China, and that only comes through getting up there, talking to the partners, talking to the company itself, talking to other foreign oil and gas companies who are operating in China, the issues and delays that they experienced, and whether or not those issues were resolved, which, as far as we could tell, the answer was yes. Whilst things may take a little bit longer, ultimately tenure was respected, and terms were left unaltered. And so, getting comforted around that point allowed us to, stick with the Sino gas investment, as that large discount you can see to our MPV there on the top left-hand side closed as the company eventually progressed the development of that asset and started delivering on its guidance, on its promises. So, whilst we view the bid by Lone Star as being, somewhat on the low end, I think, compared to what the ultimate value of that asset is. It's a cash bid. Our understanding is that a number of different entities have looked at Sino over the years, and we do have quite a long runway now until the independent experts report is delivered on Sino Gas, and we'll get a valuation out of that. We'll see how that compares to Lone Star's bid, and any time between now and perhaps the end of August, when this bid is due to reach its maturity, I think there's a reasonable chance of another entity coming in and having a look at this. But I suppose the point of all of this is getting out and doing the work ourselves has led us to more than double our money in this particular investment, and lead to a great result for our unit holders. Shifting back to the mining space from oil and gas. So Index Limited has been a fantastic investment for us. We first got onto this thematic of a mining services recovery in the wake of the Diggers and Dealers conference in August of 2016. So at that point in time, you had a large number of gold companies that were trading at very lofty premiums to their MPVs and to their mine life. So these companies were trading on sort of 8, 9, 10 times earnings, but only have sort of 4 or 5 years of mine life. And so what was clear from that conference, and it was really crystallized at that point in time, was that exploration spend was increasing meaningfully. So companies like Saracen, like Northern Star, they were increasing their exploration budgets by 200% and 300%. So it was clear that a sector in mining services, particularly focused on exploration, where there'd been an absolute hiatus in activity for 2.5 to 3 years, was about to see a resurgence of expenditure and revenue growth. And Andrew, who covers Index and had previously covered the stock and knew it very well, we sort of got together with this information and this thematic in hand, and started to compare notes and look at the forecasts out there. And Andrew came up with his own forecasts, and as you can see on the chart there, they came in well above what consensus was expecting, and we started to form up the position on that point. So I might hand over to Andrew to discuss how that played out.
Yeah, Index was a particularly pleasing investment for us, and we're still a very big part of our portfolio. As you can see, the valuation, despite the very high share price run, is still quite high. I mean, is still quite relatively well priced, despite the run it's had in the share price. But what was particularly pleasing is, number one, it was a great sign of teamwork amongst the team. Sam, being based in Perth, was feeding me back information that no one on the East Coast was telling me. No one on the East Coast was talking about mining services stocks back in 2016. It had been a brutal 4 and 5 year downturn in the sector. As you can see, there was one analyst that had a recommendation and coverage of Index, and as you can see by the red box, that was a sell. That analyst had 1 cent forecast for the year ahead, and after working with Sam on what the exploration recovery could look like, we had a forecast which was 5 cents a share, so 5 times higher. And so we started buying quite aggressively. As you can see, the portfolio weights down the bottom there. We built it up to about 4% of the portfolio, and then the thesis has played out exactly like we thought it would. So I think this shows our in-depth research, but we don't stop at just one anecdote of improving recovery. I went off to the Mining Expo in the US. That's only on every 4 years, and it's a great way to see every single mining services company and technology company in the world presenting their wares. So not only did I see Index as per the photo there, I visited all their competitors and some other investments that we had at the time, some of their competitors. Spoke to a lot of customers. There was particularly one geologist who ran into me not long after this photo was taken and wanted to buy me lunch to tell me how great Index was and how much of a difference it was making to his mine in Canada. So that sort of feedback is invaluable, and that's why we spend so much time on the road. Another great example of leveraging Sam's West Coast presence is Seven Group Holdings. Seven's a big company, $3 billion market cap, but we actually thought it was quite poorly covered. What we noticed here was, given the name and given the history of the company, everyone sort of remembered it as a media company. Yes, they might have WestTrac, but why would you want to buy WestTrac Caterpillar exposure? Mining services just weren't that exciting to the market. But we did like the WestTrac exposure. We saw the recovery there. When we did the analysis on the valuation, their holding in Beach Energy, which Sam also covers, was actually worth more to them than the Seven media holdings. So media was becoming less and less relevant for the Seven Group valuation. And we started building a position based on the WestTrac improvement, and they also owned at the time 50% of Coates Hire. And for those of you based on the East Coast, you'd be aware of the huge infrastructure boom which is happening and has probably got 2 or 3 years to run. Well, Coates Hire makes most of its money from very long duration assets where the hire gear stays on there. They might have a contract for a year, but typically it takes 2 years to build, and that's where they really make excellent money. So we like the Coates part of the Seven Group business. And so when Seven Group was raising money to buy Coates out 100%, we cornerstoned that deal with our brokers. We were very attracted to that asset. We had 5 years at least of history. It was a known buyer, known seller, very friendly deal. They'd had half the asset for 5 years. So there was no surprises coming to Seven Group from buying going to 100%. And what we're amazed by is post that deal, that the shares getting issued for the deal, consensus just didn't move. So if you look at that blue line, a couple of brokers were happy to put in the extra shares on issue, but the way compliance is these days, some of the larger firms would not put in the earnings coming from having 100% of Coates versus 50% of Coates until it physically settled in December. So you had this ridiculous situation where consensus was wrong by a material amount. As you can see there, it's about 20%. And we used that period there of 3 months to aggressively keep buying the stock. And surprise, surprise, when the deal's settled and the big firms put out their EPS upgrades, to our minds, nothing had changed. We already knew the company was going to earn that much, and anyone who'd done their homework would have known that. But given how pervasive quant buying is in the market, the quants got hold of the stock on the back of the EPS upgrade and pushed the stock close to $20. So even in a $3 billion market cap, we're still finding inefficiencies. So to our earlier question, can we still find good investment opportunities? These sort of examples are coming up every day. On a slightly different topic, and this is a very much short and sharp opportunity where we had to move quite quickly. Speedcast was a stock we had a reasonable position in, around 1.5% to 2% of our portfolio back at the beginning of 2017. Speedcast provides offshore communications, mainly satellite-based, to the marine industry. So quite a good utility in a growing industry, particularly cruise vessels and the recovering oil and gas sector. They put a result out in August 2017. They just made a very large acquisition, so there was quite a bit of confusion around the accounting for that acquisition and what the impact was to earnings. We, as a reasonable shareholder, we had a one-on-one with the company the day of the result. Myself and William Wu, who's the analyst on the stock, went through in great detail with the CFO on all the impact on boring things like depreciation, amortization, which most people don't bother about, but we like to get every part of our model right. And we saw there was probably a 10% upgrade once the market got their head around what's the earnings were happening at Speedcast. We were just as shocked as anyone else when a major firm who I won't name or embarrass put out a 15% downgrade the next day. This was a junior analyst who had just taken over the stock, but he worked at a very big firm, so had quite a big impact. The quant funds I mentioned before, they made quite an impact on the share price that day. So where you see the X marks the spot there, we were buying that stock in size, in volume during the day at that price. We doubled our position, and by the close of the next day, we're already 15, 20% in the money just on that trade. So these inefficiencies keep popping up, but to take advantage of them, you've got to have done your research already, and you've got to be ready to move swiftly when these opportunities present. A longer term story, and this is an example of a stock. We're always on the lookout for these sort of stocks. Some of you might be familiar with Navigator, this key business, which is Lighthouse Partners. But this company used to be called HFA Holdings, which may bring up some bad memories for some on the call. It was a bit of a high flyer into the GFC, had some structured products, and the stock got severely oversold after the GFC and forgotten about. I remember sitting at my desk in January. It was a pretty quiet day, and I had a model on HFA, but I must admit I was only updating it every 6 months. Didn't seem that exciting. And they came out with a profit upgrade. I quickly went through my numbers, updated my model, spent most of the night making sure I had everything in place. And the next day we started buying quite aggressively. We had to track down a hedge fund that held some stock in New York, and we bought the stock off him while he was commuting in on his daily commute. Because again, he had no broker numbers to reference to. He's probably a legacy position for him, and we were able to take advantage of what was public information. We just processed it faster than the market. So we built a position at 93 cents. And since then, the stock has done really well for us and actually had a really good month last month. Multiple catalysts have come through. But I guess what we want to show here is if we can pick a stock when there's no broker coverage, it tends to be quite a lot cheaper. The earnings growth is unappreciated. So not only do you get the earnings growth, which, as you know, drives share prices, you also get a re-rating in that stock. So people are prepared to pay more for that growth as it becomes more mainstream. So Navigator, as it's now known, has gone into the index, the small cap index, which people start to look at more, and broker coverage has really picked up. And then they've had excess cash on their balance sheet, which they then just deployed this month in a Mesero transaction, which has led to further upgrades to the market. So these are the sort of examples myself and the team are out there trying to find each day. Another really positive that we see in the small cap market is typically when big companies want to grow, the quickest path is to buy a smaller company. And the great thing about small caps is there's plenty of targets. So we could probably run through our portfolio at the moment and come up with a list of 10 to 15 stocks which would make logical takeover targets for their bigger cousins. And clearly in takeovers, you get paid a premium. Sam mentioned Sino Gas has a reasonable premium of 19 cents, but that's almost double the share price from 6 months ago. So that's a good start. We haven't sold any shares yet. We'll wait and see if we can flush out a higher bid. But this is a sort of theme that we expect to continue and certainly did help our performance last year. Some other examples, Integral Diagnostics. What's also important there is there's obviously a temptation when you get a bid in one of your biggest stocks and it goes up 24%. The first temptation would be to sell it. But we actually did some more work on why was someone so interested in buying Integral Diagnostics. And we thought maybe the market was underestimating the growth. There was a new managing director in there, which we had a high regard for. He was cutting costs faster than the market. And in their takeover defense documents, a lot of that came to light. So we updated our numbers and we supported the board and were one of the key shareholders in rejecting the bid. That stock's now gone on further and is now up about 50 cents. So not in all cases do we accept the takeover bid, but it is a great way to shine investor interest onto the stocks. Life Healthcare was another stock which had been in our portfolio for more than 4 years. Was a bit unloved. It had an early stumble just after IPO, so we used that weakness to build a good position. Healthcare is a sector that everyone wants to get into from around the world, and it was an offshore private equity fund bought in. And another more recent example, Sealink. We were in this float. We were cornerstone at the float, made a lot of money out of the stock. Valuation got a bit stretched. We came out of it. More recently, the market's got a bit bored with Sealinks. It looks like it's growing, single digit. People are looking for more exciting things. We thought actually single digit growth in a high quality business is not too bad. The valuation improved. We bought back in, and then just last month, they announced they'd rejected a bid. We still don't know who the bidder was, but clearly that's shone the light back on Sealink as a good value play. So we expect M&A activity in small caps to continue to be a theme. Another theme which I might get Sam to talk about is it's certainly been a headwind for our style of investing, and that's momentum has been in a strong style driver of returns for the last 5 years. And I'll get Sam to explain this one.
Yeah, so just to walk you through the two charts we've got there. The first one is a measure of PE compression or expansion. So what we've observed over the last 6 years is as growth and momentum have been key drivers of overall market returns. You've started to see an increasing number of stocks become these market darlings, starting to trade on sort of 25, 30, 40 times earnings, and that's been a real headwind for value style investing over the last 5 or 6 years. And then below that, you can see how our 3-year rolling performance as compared to that PE compression. And you can see when we do our best is when PEs are starting to compress. And with our sort of peak out performance over 3 years, they're running up around 10 to 12 to 14% alpha in that sort of 2012 period. So now looking forward to the end of the charts, we are moving into an environment of higher interest rates. This sort of zero inflation environment has definitely come to an end within with an increasing rate environment. It's generally helpful for value style investments to outperform. And we've started to see that, just little sniffs of that so far over the last sort of 6 to 12 months or so. So hopefully this switch in thematic continues to play out because, momentum and growth have definitely seemed to have its day. But as Andrew just walked through on the previous slide, with people looking at value, I mean, some of these companies trading on low multiples, they start to invite bids. And I think that'll help to shine the light on that part of the market, and then should help people look, more through the value lens at their prospective investments.
The other reason why we think it's important to stick to your value disciplines is if you look at the average PE of the small cap market, hopefully from this chart you can see that the average PE of the index, so that's a small cap index, if you just went out and bought the index, this is what you'd get. That's trading at quite a premium to the average. In fact, it's one standard deviation above average, as shown by the dotted line. And as you can see, historically, it never stays there for too long. And so obviously started to come back a little bit lately. So to protect our portfolio from this potential downturn, we only invest in good value stocks. So X marks the spot for us. You can see our portfolio on average is around the long-term average of the small caps. So we think in a sell-off, and they do come around every now and again, our portfolio should outperform in a down market. And here's a bit more explanation of how we look at value. So our portfolio is on average 12.8 times. That's a healthy 21% discount to the market at the moment. Our yield's about 9% better than the small cap market. So at the moment, we're on average got a 4.7% yield, and yet we've still got very strong earnings growth, almost twice the earnings growth of the market. And finally, here's our performance. So despite a value headwind, last year's been a very good year. I'm very proud of the team and what they've all delivered. it hasn't been any one particular stock that's driven that performance. It's been hard work across a number of positions, and really getting us back towards the returns, as you can see in the 10-year number, we're more used to out of this strategy. And so, with further hard work and discipline, and we've invested in our research team, we hope to continue these returns for our investors. And important to add, these are net returns after fees. And finally, before we hand over to questions, I'll just leave up there our current top 10. As you can see, Navigator we've talked about. Gateway is a stock which has been a bit disappointing for us, but we see very little downside. In fact, our downside bear case valuation is $1.80, which is exactly where we're trading. So we maintain a strong position despite that being unloved by the market. And as you could see, a really good spread of industries. We're not betting the house on any one sector, any one commodity. We like to spread our risk across up to 60 names. And with that, I'll hand back to Caesar to moderate questions.
Thank you very much, Andrew and Sam, for those wonderful insights. Certainly a very interesting sector of the Australian market, and we've seen a very strong year. So we do have a couple of questions there. I might open up with one of our own questions, if you don't mind. So Andrew, so obviously the overall market's looking a little bit expensive. We've had a very strong year. Where to from here?
Well, that's something we sort of consider every day. We're always looking forward. You can't. Every day is a new day in funds management, so you can't live on past performance. So we're raising cash at the moment. It was really interesting. May was confession season, as it always is. So companies that were struggling a little bit with their earnings were owning up to the market, and we had quite some severe downgrades. Thankfully, we avoided most of them, and we had good performance last month. But what that has created is a basket of stocks which look potentially oversold. So our analysts are out there right now doing more work on these stocks, seeing if the market's overreacted, as it tends to do. And these could be a fertile ground for next year's winners. And you're obviously locking in profits in some of our recent successes to recycle capital back into cheaper names. I do think the market's had a good run. We're in for volatility. I think that continues. As Sam mentioned, long-term bond rates are going up. That's going to cause dislocations in emerging markets, potentially commodities. And that's something we monitor very closely. And that's why we have 60 stocks in our portfolio, just to spread our risk across a lot of sectors and a lot of companies.
Thanks, Andrew. And obviously the valuation in our portfolios looks very attractive relative to the market. Question from the audience. Given the run we've had in resources so far, where are we in the cycle? I guess that's probably a question for Sam.
Yeah, thanks, Caesar. I don't think we're quite close to the peak yet. The reasons for that, just from a very broad macro view, I think that we're only at the early stages of this increasing inflation thematic globally. This is popping up everywhere, and I think that does have quite some time to run. And an inflationary environment, generally speaking, is a tailwind for commodities. And the other part to that, there's probably two other parts to that answer. The second one being that we are yet to see a material supply response in the commodities. I mean, we're only just starting to see a bit of capex coming back, say in iron ore in Western Australia, and a little bit around the US shale oil. But for mining specifically, this is only replacement capex. There's no growth. And demand for these commodities is ticking up with sort of global GDP. So new growth is going to have to be added, and it's not being added yet. And I think just lastly, with regard to China, I mean, that's going to have the handle or the whip hand in terms of commodity demand in the short term. But I mean, Andrew and I have both been through China separately this year. I think we both came back with the view that the government seems very much in control of the debt situation and issues up there. And for the time being, I think they're sort of going to manage through to a more consumption-dependent sort of economy, along from a fixed asset investment sort of based economy reasonably smoothly. And then behind that, you've got, another sort of 1.6 billion people throughout ASEAN nations. So that's your, Vietnam, Thailand, Indonesia, which I was at yesterday, along with India. I mean, collectively, there's 1.6 billion people there, with about 0.6. with about 60% of China's GDP, or equivalent to China's GDP in 2010. So, this is a huge number of people that still want to go through the same industrialization process as China did, and that's going to require more commodities and therefore more commodity growth. And to inspire that growth, you need higher prices. So it's not going to be a straight line, but I don't think we're there yet.
Thank you, Sam, very much. Before wrapping up, we probably have time for one more question. Probably a question for Andrew. Your thoughts on Morningstar's current 2-star rating on your fund, and the interaction with portfolio managers, etc., between this fund and your microcap fund?
Okay, so that's a question from Greg.
That's a question from Greg, yes.
Yep. So we actually, good timing for the question. We just had Morningstar team in this morning reviewing the small cap fund. So I suspect it was a very positive meeting, but they'll make their own view and update that in due course. What we understand about the star rating system is it's relatively backward looking. Obviously we've posted very healthy numbers versus our peers this year and getting back to our long-term track record. So we're hopeful of an improvement in that rating. And separately about the microcap fund, the differences. Sam and I are both also involved in the microcap fund. The differences would be we're looking 2 years out for value in our small cap fund, and we're looking for relatively liquid exposures. With a microcap fund, we're looking an extra year out. So we're looking 3 years out for value. So a stock which might have very high growth but looks expensive this year, if we're looking 2 years out and it's got a solid balance sheet, we will add that in our microcap fund. And obviously we can go right down the market cap spectrum. Some other differences with our microcap fund, it has up to 20% cash because we want to maximize liquidity in that very illiquid end of the market. We can also invest in pre-IPO opportunities. That hasn't been a big driver of our performance in microcaps to date, but potentially down the track, buying some of the pre-IPO names might help us, help performance, and that's something that's only available through the microcap fund.
Thank you very much, Andrew. Just to reiterate on Morningstar, the star rating system is a largely backward-looking quantitative rating, whereas on a qualitative rating basis, we're neutral, which is an investment-grade rating by Morningstar. Look, thank you very much. And just to wrap up on the last slide, obviously both funds, today's webinar is about smalls, but both, given the recent question, both our small caps and our microcap fund have solid recommended ratings from both Lonsec and Zenith. They're on all major platforms. And what we'll be doing after this is sending you a copy of the presentation and also a recording of the webinar. So feel free to share that with any of your colleagues. And look, thank you very much for participating today in the Perennial Value Smaller Companies live webinar. Have a great day.